Shankar Sharma then of First Global, he's extremely bearish in banking stocks and he's of the view that there is a lot more pain left in the sector. Let's hear out his conversation with Nikunj.
My view was that banks were a real sitting duck to fall. I mean, those kind of trades come once in 4 or 5 years. It was an absolute no-brainer. And what made it an even bigger no-brainer was that nobody is willing to listen to any contra view on banks. They were over-owned. They are a poor quality business that was made to look good because of economic growth. When economic growth slows down, then banks are the first casualty because they have huge leverage on the balance sheet. That's the nature of the business. So what is happening today is not surprising at all. And my view, I don't think the move is over by any means. I think they have a long, long way to go before they... and frankly, in banks, the strange thing is, or the funny thing is that they have no fair value. Because of the high leverage, that's the way the business is run, 10, 12, 15 times of leverage, then the equity can evaporate. So there is no saying that at half book a bank is good, which used to be 3-time book. Because you don't know whether the book itself is stable or whether it's just going to evaporate and become a minus or a negative book number. And that has happened through time immemorial across the history of banking across the world. So India kind of dodged that trend for a while because it was still a nascent market. And in any nascent market, you will find that global parameters don't really hold. So like commodity companies back in the early 90s in India, it used to trade at 25 times, 35 times earnings, while global commodity companies would trade at 5-7 times earnings. And people used to say India is a different thing. But now you see that everything converges down to what are global parameters. Indian commodity companies trade at single-digit multiples. So banks in India have been too expensive. They have been too profitable in my view. I see no reason why banks should be making anything between 1,200 crores to 10,000 crores for doing nothing really special. They're not even good at prop trading. If they were good at prop trading, I can give you unlimited profit because you have a special edge. But to just do borrowing, lending, and a bit of treasury to make 3,000 crores, 4,000 crores, 10,000 crores of profit, that is too much. These numbers have to collapse. They will collapse over the next few years' time. So bank stocks, even at 50% lower than this, would still be a hard case to make for a buy.
Would you say that for PSU banks as well? Because they have corrected almost 50-60% from their highs. Valuations are not all that bad. And whereas there is argument for private banks which is not favorable, what about the public sector banks?
No, I never look at valuation. I mean, central to my way of looking at markets is not valuation. I mean, every once in a while you will find stocks or a sector that has become genuinely cheap. Those are rarities. By and large, I never pay any attention to multiples and stuff like that. The fact of the matter is that they might be down 50%, the PSU banks. But again, I don't think it's a secret anymore that sort of the bad asset part of Indian banking is coming to fore now. And the more things decline, the worse the numbers become. So that what is not an NPA today could become an NPA a couple of quarters down the road. And you see, interestingly, all the companies to whom the monies have been lent, the big monies have been lent, have been companies that have come into the fore in the last bull market after 2003 or 4. And almost none of those companies have any quality business. None of those companies. All the good companies we can compel ourselves to buy today are all companies that were formed in 1910, 20, 30, 40, 50. Nothing from 2003 onwards can you put your hand on your heart and go out and buy today. Because they were all poor quality businesses, whether it's construction, real estate, power, retail, stuff like that. Those are all poor quality business made to look good for a brief while through a lot of accounting jugglery, through a lot of easy money being given to them. But the core businesses are bad, and that's where the big monies have been lent. I mean, if you look at Vishal Retail for that matter, I don't understand how banks ended up lending so much money to a business which is a retail business where there are no real assets.
Look at construction companies.
Look at construction. There are no assets in construction. There's nothing. You're just a service provider to the ultimate builder. Why on earth have the banks gone and lent so much money to these people? So they have to pay the price for that. And it will be the same thing on the retail banking portfolio. Let's not kid ourselves even for a second that when the large economy, the industrial economy is going to hurt so much, then the employment sector is not going to hurt. People will be being laid off, or incremental employment opportunities won't be good. In both those situations, you will see the retail assets from banks also taking a big cut. And retail recoveries are a lot more difficult to do than a corporate recovery, where you have personal guarantees of promoters, you have assets, you can do something. The retail guy, you lent money, he's gone off to his village in Bihar, he's not going to come back and pay your money. So that people are still not understanding that in a downturn, you will get hit on retail assets as well as the corporate assets.
So with that logic, is it time now to hunker down expectations, especially growth expectations for a second half recovery?
I don't know what people were smoking when they were talking about a recovery. I mean, I do understand strategists and economists keep putting out this kind of stuff every once in a while because they have a job to protect. I mean, unfortunately or fortunately, I'm not employed. So it doesn't matter. I can afford to say or see things the way, at least I see them. And I've never bought the story that in second half of this year, and second half is always supposed to be better than the first half. You go back 100 years, all managers will tell you, sir, this quarter is bad, this half is bad, but next half will be very good. All analysts will tell you second half is good. So it's like a catch-all motherhood statement. It means nothing. Okay, when the second half comes and nothing is good, then we'll say the next second half upcoming will be better. That's how we keep ourselves interested in our jobs. I was never of the opinion that the economy will recover. In fact, in my view, let us also adjust to the fact that the world is sitting on a growth cliff. Okay, it's an absolute cliff. And in my view, over the next 12, 18, 24 months' time, you will see the world fall off that cliff. The US is growing 1.5%. People are saying, or maybe 2%. People are really breaking out the champagne and saying, wow, that's terrific growth. And I say that's rubbish. I mean, you have pumped in $4 trillion directly, plus the subsidies by way of almost zero interest rates. And after that, you're growing 1.5%, 2%. So please, remove this painkiller and tell me whether the pain is actually gone, or is it just being masked by this huge surge of painkillers into the system? If this liquidity were to be withdrawn, or even tapered, even brought to neutral, forget being withdrawn, then what growth are you talking about in the US? 1%, 0%, -1%, -5%? It cannot be 2% for sure. So, I mean, what growth have you achieved? China has grown 7.5%, pumping in trillions of dollars. What kind of growth is that? So there's no growth in the world. You're just trying to artificially stimulate a dead patient. Okay, it looks as if he's alive, but the growth patient is dead. Let's adjust our targets down as business people, as individuals. If we don't do that, then we'll keep banging our head against the wall and keep blaming Manmohan Singh and Chidambaram and keep hoping that a messiah called Mr. Modi will come and solve problems of the country. There is no such thing. There is a genuine problem everywhere in the world as far as growth is concerned. And in my view, India has done an excellent thing, which is what happens when you have smart people running the country, that we have not busted our national balance sheet in chasing growth. Every country in the world of size or substance has bust their balance sheet. Europe has completely tapped its balance sheets out. US has done the same. China has done the same. India has grown 5.5%, 6%, or it will grow about that much without really busting your debt equity ratios for the nation. In my view, that is terrific quality growth. If you spend $1 billion and grow 10% and I spend 0 and I grow 8%, which is a better company? So how come we have forgotten all our corporate finance and security analysis principles when it comes down to analyzing the country? So everybody writes the obituaries about the country and how bad we are, without looking at that. Guys, we are growing 5.5%, 6% without spending money. China growing 2.5% point more with an out of control debt market. US out of control. So in my view, hunker down your expectations. That is the reality of the world today.
But whenever things will recover, if your logic is that, look, we are the best of the lot, there is a self-engineered slowdown in China, there is a political problem in Brazil.
There's a self-inflicted, not a self-engineered. There's a difference.
Self-inflicted, okay.
Yes.
Self-inflicted problem in China. Do you think whenever recovery will come back, India will be the first one to recover?
Look, now that's a difficult one to answer. The reason for that is when you have leverage, usually if you talk in the company sense, a leveraged company recovers faster than an unleveraged company. Because the moment your profits reach a certain level, you exceed the cost of debt, that means the cost of the interest payments, your profit ballooning is tremendous. So on a country basis also, a leveraged economy can, in theory, recover a lot faster than an unleveraged economy. India is relatively far lower leverage than almost every major economy that you can talk about.